Okay, good morning, everyone. My name is Dean Christians, and I'm one of the three research analysts at SentimenTrader.com. My colleague Jay Kaeppel is also here today. Thanks for taking the time to learn more about our research services. For those unfamiliar with the firm, I thought I'd start with a little bit of background. Of course, Jason Goepfert founded SentimenTrader in 2001. And if you're unfamiliar with Jason, Jason is really one of the foremost authorities on sentiment indicators. He's created dozens and dozens of proprietary indicators. And quite often, when the media is trying to figure out what's going on with sentiment, Jason is one of the first people that they call to get his insights. Jay and I joined SentimenTrader in 2001, and we both worked in the money management industry for a few decades. And while it's a team-based approach and we're all generalists, meaning we will publish research on any subject matter, generally speaking, Jason tends to focus on sentiment indicators and signals. I'm a big proponent of market breadth, so you'll see me publish a lot of research on market breadth studies. And then Jay is really one of the foremost authorities on seasonality and really in the world. And again, we can publish anything we want as long as we find that it has an edge, but those are sort of the general areas that we tend to focus on. Our research notes are really structured to provide concise yet impactful insights. Each note follows a clear format designed to deliver key takeaways, quickly focusing on actionable information and data-driven conclusions. This is what really sort of separates us from other research services. There's no subjective opinions. It's really about the signal, the pattern, and showing you historically what has happened either to the S&P or the NASDAQ or an individual stock following a typical pattern. So generally, we publish 8 to 10 research notes a week. If you subscribe to our research report package, of course, that can vary, just, sort of depending on market volatility. Could be more, could be less, but that's kind of what we do. And we also have a weekly summary and that research package. And that Jason does a great job of sort of summarizing the signals that each analyst has written about each week. And I find that to be, just a really valuable sort of big picture report that, you can sort of comb through over the weekends, especially if you're just a sort of a casual investor and you're just generally kind of get understanding of, is the market environment favorable, unfavorable? That weekly report is really good. So let's take a look right now at a recent research report that I published so that you can get a general understanding of what we provide in terms of our research reports. And then after that, we'll go through our website and we'll show you some of the tools that we use and we look at on a daily basis and how that helps us to provide research. Okay. So on October the 2nd, I published a research note on the utility sector talking about the overbought condition. And this is the note that I want to review today. And again, like I said, all of our notes are structured in the same manner. They're meant to be clear and concise. And when you open up a note on the website, you'll be able to see like sort of the 10 previous research notes that I've published. Just as a reminder, I publish under the Model Edge report. Jason publishes under Sentiment Edge, and then Jay is under Kaeppel's Corner. And again, let's just kind of run through a typical research report, but we've got our title. If an analyst chooses to put a forecast on a note, so in this instance, I put a forecast that medium-term forecast, which is anything from 1 to 6 months. I said that utilities would most likely be down based upon this historical pattern. And again, we have a key points section, and this just gives you just sort of a general idea of the signal and potential, outlook for the sector. We provide a brief sort of summary of why we're sort of looking at this signal and what happens. We provide a chart so that way you can visualize historically when this indicator is triggered. And occasionally we'll have in here annualized returns. So in this instance, when the percentage of S&P 500 utility stocks trading above their trading within 5% of a 252-day high, exceeded 95%. The utility sector analyzed at a negative 20% rate. Now, it's extremely rare, but again, this just gives you sort of a secondary input to know what happens to the market when this pattern triggers. If we scroll down, this is sort of the bread and butter of our research. And again, this is what really separates us from other services. We provide this outlook table. Again, you get a chart with a little red dot that shows you the signal date so that you can sort of visualize when this has happened throughout history. We then have the signal dates and the forward return outlook, from 1 week to 12 months later. We provide the mean, the median. Of course, the percent positive gives you the win rate for this signal. And then we also provide average max loss, average max gain, and then a Z-score. Now, what does the Z-score tell me? Well, the Z-score tells you, basically compares the signal return to random returns over the study period. So if we just took this 1 month period, what we see is on a median basis, utilities fell 3.6%. On a mean basis, 3.4%. It was positive only 11% of the time. And what that means is that with a Z-score of negative 3.7, that return relative to random returns over the study period was significant. So this is something that you would want to pay attention to in terms of the utilities. If we scroll down further, we also tend to provide a table here that provides this average and median max loss and gain. And then we show also how many times this signal maybe had a 5% drawdown or a 10% drawdown, so you can get a sort of an idea of risk relative to reward. If we scroll down further, we can also see that quite often we'll provide an outlook table for sectors or the S&P itself. And again, what we see here is utilities are very weak. We see negative returns across every single time horizon. We see, very low win rates across every time horizon. And then if you compare that to other sectors, or if you compare it to the S&P 500, what you can see is this is something where, okay, I really, if I'm long utilities, I don't want to be holding utilities, or maybe I want to trim back some utilities if I had a long position. But this provides you with sort of a relative outlook comparing utilities to other sectors in the broad market. In this note, I also showed an additional signal, which we will quite often do. So when we can, we want to provide you as much detail and as many insights as possible as it relates to a specific, sector or index and what is taking place with that. So in this instance, I provided also when the utility sector stocks outperformed the S&P 500 on a 1 month rolling basis and 3 month rolling basis, when that was over 90% for both of those, bad things tend to happen to utilities. As we all know, utilities are not really a momentum sector. They're traditionally more defensive. They are higher yielding. And so when you see big momentum up moves in utilities, that's something that you typically historically want to fade. Again, providing here another table with that max gain, that max loss, and then again, another summary of relative performance. In this note, I happen to actually provide some insights because on our website, we have a strategies page where we track various strategies using price momentum and relative strength. And one of our relative strength models actually picked up the utilities as a long trade on May the 15th. And actually utilities since May the 15th have outperformed the S&P by a significant amount. And so what, I said here is okay, well, we have two conflicting signals. We have this overbought condition, but yet, our strategies were long utilities. And so in that instance, I said, look, the prudent thing to do would be to take some profits. And then if this signal goes to negative here, based upon our outlook for this overbought condition, then we can exit the position. But this type of insight is what, we'll provide in each one of our notes. And then lastly, we summarize it, and just give you sort of an idea of, what we talked about, what the outlook is, and if there's any other insights that we may provide that are meaningful. One of the things that we do for each research note is we provide what we call a tag, which is content. And so what you can see here is on this note, I tagged market breadth, I tagged utilities, and I tagged relative strength. Now, why do we do that? Well, so if you're searching our website or if you're on the public blog, you can quickly find topics of interest. So let's switch over to the blog real quick. And what you can see here on our blog is we broke out some of these tags for you. So if you want to see, what we've written about in terms of market breadth, you can click on the market breadth tag, and then it'll pull up all the notes that have market breadth tagged. Maybe if you want to see something about commodities, seasonality, if Jay's written something about seasonality, you'll find that in here. And then again, we have just, our individuals. So if you want to see what Jason has written about, you can go to Sentiment Edge. If you want to see what Jay's written about, you can see Kaeppel's Corner. And again, I publish under Model Edge. And then, of course, you can do a search. You can type in gold here, click the search button, and then you'll see anything that we've written about gold or perhaps gold miners. If you're not a subscriber and you want to get a general sense about our research, we have this free for public. Each month we pick 1 to 2, 3 articles from analysts, and we make those available. A month later we make those available, so you can kind of get a general sense of what what we've written about and this format that we just talked about. And again, predominantly our formats are the same. Jay, with a lot of the seasonality or strategies. Rather than an outlook table, he may use what we call growth of a dollar. So we may say from point A to point B, what is the growth of a dollar? And so you can visually see that, whether that is a meaningful signal or not. Just kind of going back to this note in terms of the utilities. Like I said before, Jason is quite often quoted in terms of sentiment analysis. And interestingly, this utility notes was picked up by Bloomberg, Reuters, and Barron's, and they each had an article quoting this research here. And again, just to sort of summarize, again, you won't find our sentiment indicators anywhere else in the world. Like I said, Jason has created dozens and dozens of sentiment indicators. And actually, there's a lot of other research services that subscribe to us because they want to know what's going on with our sentiment indicators. Market breadth is also another area where we have historical data that goes back, to the 1920s. And you're not going to find that with a lot of other research services. And for instance, you can see here that we have this breadth data going back to 53 for the utilities, which we have for all the other sectors. And again, we have breadth data going back to the 1920s for the S&P 500. So again, we provide that sort of historical perspective that other research services simply just can't do, which we believe is really an edge and what makes us stand out. Okay. And again, just to give you a little perspective, since publishing this, this research report on October the 2nd, where I said I put a negative outlook on utilities. Well, utilities since the close of the 2nd are down roughly 3%, and at that same time, the S&P 500 is up 1%. So, we have a signal here that we highlighted that has worked. Again, not all of our signals work. The market sometimes will do what it wants to do, but this one was a signal that was very interesting that the media picked up on. Okay, so quite often we get questions, from subscribers or the public, and they always say, well, hey, what are you using on the website? What are the sort of go-to tools that that you're looking at on a daily basis? And so I thought we'd switch over now and just sort of give everyone sort of an idea of what I kind of look at, and then Jay can chime in and he can provide some details on what he looks at. But one of the tools that we have on our website is called the Risk On, Risk Off Indicator. And this is a composite which comprises 21 breadth and sentiment-based indicators. And you can see these sort of thumbnail charts here with all the various indicators. that are included in this composite. And again, this will give you a real good sense of, is the broad market in risk on mode or is it in risk off mode? And of course, if we're in risk on mode, that's when we want to be aggressive. We want to be long stocks. We want to be trading from the long side. If it's in risk off mode, we want to have a more cautious approach. That doesn't mean that there aren't going to be stocks that go up, but broadly speaking, the general market should be under pressure. Again, when this indicator crosses above 67%, it's in risk on. When it falls below 35%, it's in risk off. And again, just to give you an example of how I use this, about a week or two ago, I was on here and I was just kind of scrolling through, looking at all the thumbnail charts, and I noticed that the McClellan summation indicator, which is a breadth-based indicator created by the McClellans, had risen above 1,000. And I said, wow, that's kind of interesting. Let's take a look at that and see what that has, if there's any meaning to that sort of rise above 1,000. So what you can do on our website is click on McClellan summation, and that will take you to a bigger chart with the S&P overlaid and subgraph 1 and the McClellan summation index, which looks at NYSE advancing and declining datas. And we can click on all and sort of get a general sense of, oh, wow, when this has risen above 1,000, it looks like the S&P goes up. And so one way we can test this with our tools on the website is by using our BackTest engine. And if we scroll down, we can see here, we can go to BackTest engine and we can click on that. And again, for traders that, want to look at BackTest and have their own sort of indicators and models and systems, we provide that to you in our essentials package. So again, we sort of have 3 packages. We've got our research reports, we've got our essentials, and then we got our essentials plus market scanner package. And within the essentials package, you can use this BackTest engine. So again, what we have is a very simple, pre-formatted interface here. You don't need to have any programming skills. It's just simply, hey, point and click, and then we can create our sort of own backtest so that we can view what happens when a historical pattern triggers. And again, we have, it'll load the McClellan summation in here. And again, it's very simple. You can do single conditions. You can do multi-conditions. And what I'm going to do is we'll skip through this process, but I just wanted you to see the interface is very simple. And then what we can do is once you create a backtest, you can then save that, right? And so you'll have a history, and then you'll have a favorites folder. And once you create something, you can add it to your favorites folder. And then once it's in your favorites folder, each night or in the morning, you can come in here and you can click this Find Last Signal button. It'll scan through all your backtests and provide you with which one have triggered on that most recent day. And so let's take a look at the McClellan summation. And again, if I quickly click on this, we'll see that it pulls that McClellan summation study up. And then what we do is we provide a chart, and I'll just click off on the exit signals. But so again, graphically, we can see when this is triggered. And again, what I coded here, or just quickly formatted, was let's look at the McClellan summation index anytime it's gone from below 100 to above 1,000, which recently occurred here. And I published a note on. So if we look at that, we can see graphically, okay, well, this looks pretty bullish. Then we can come down and we get a summary of all the statistics. We get an equity curve. And of course, with equity curves, you always want to see it moving from the lower left to the upper right. We see an 82% win rate. And again, that's just over the time period that I selected it for. If we come in here, we can see trades. And then you can see each actual individual trade where we bought or sold the S&P 500. One of the things that we do that, again, is very unique that you will not see with other providers is this market condition. And what you might see in here is like bull or bear. And again, what this will tell you is this signal triggered in a bull market or this signal triggered in a bear market, this signal were triggered in a recession, or this signal triggered when the Fed was tightening policy or easing policy. So that gives you a framework of when this signal has occurred throughout history. And oh, by the way, when you chart our indicators on the website, you can also use those overlays. So if you're looking at something, you say, well, I want to see how this is, this indicator is moved up or down in bear markets or bull markets or during tightening cycles or recessions. You can overlay that. It'll paint the background gray. And then so you have some perspective on when that's happened throughout history. If we also have various tabs in here, so exit with different time and markets. And again, here's our outlook table, which I showed you in our research reports. Everything we do, whether it's our research reports, our backtest engine, or other tools, provides you with this outlook table so that you can assess risk relative to reward. You can understand when these market patterns have triggered in the past. And, one thing, when it comes to trading or investing, a lot of trading investing comes down to confidence, and if your confidence is shot, right, or you're on a losing streak or, things aren't going well, this really helps in terms of understanding that, okay, this signal's triggered in the past. It has a favorable outlook. That doesn't mean it's going to have a favorable outlook this time, but history suggests if we're in the market enough that it will be favorable, that the odds are tilted in our favor. So again, we have this outlook table. We provide a lot of the same details here, whether it has significance, the win rate, the median return, and all that, and that gives you a good understanding. Same thing, we provide this max gain, max outlook. We can also see what sectors, how they've performed when these signals have occurred in the past. And so again, if you're a more advanced trader and you're looking for a tool that you can use to assess risk relative reward, our backtest engine provides that for you. And again, you can look at big picture sentiment or breadth studies to get a general understanding of what's going on in the broad market, or if you want to assess what might be going on in terms of an individual stock, you can do that as well. So let's go back down here, and we'll take a look at my favorites, and I'm going to and then within here you can also do a search. So I'm going to do SMCI. Oh, whoops! I'm going to type in super micro and click the search. Maybe I need to do SMCI, sorry. Oh, there it is. Okay. So, I don't know if you remember back in March, Supermicro computer gapped up 10%. And I published a note on that just, a day or two later. But what I did is I used our backtest engine to see what happens to Supermicro computer anytime it's gapped up 10% or more on the open. So if you're an individual trader and you're looking for ideas, or you want to test a theory on an individual stock, our backtest engine can provide that for you. So if we look at this real quick, we'll view the backtest engine results. And, we can quickly see here that, here's this opening gap indicator, and that anytime that Supermicro computer has gapped up 10% or more, the stock has risen 91% of the time over the next month. And of course, if you look at the chart of Supermicro computer, after I published this note, I think it rose like 181% over like a 2-month period. So we have the tools here. If you're interested in individual stocks and knowing what has happened after an event or a price pattern has triggered, you can come in here and use our backtest engine and again, assess risk relative to reward. So that's a couple of examples there in terms of how you can use those tools on our website. We also have a correlation pattern match tool So what this tool does is it looks at the daily returns of any security on our website, and say, let's take a look at this crude oil example, but say you want to know, well, crude oil over the last 2 months has gone up, 20% or 30% or whatever may be the case. And you want to compare that to other times in history. And again, with this example with crude oil, what we're doing is we're looking at this period from June of 23 up to October of 23, where crude oil had a extremely large rally. And what I said was, well, let's go find every other time in the period when this has happened to crude oil. And again, we have a very easy user interface here. You can select your start and end dates for crude oil. You can say, daily, and then we can plug in a correlation percentage. In this case, I used 90%. So this will go out. It'll look for every other period in time that had a 90% match to the daily returns between June 27th of 23 to September 29th of 23. And then it'll provide us with that outlook. And again, same thing in here. We sort of get these details in terms of what the return is for crude oil. We can see these multi-time results. And in this case here, look at this. Crude oil over the next 2 weeks was down it was down 75% of the time, with a median loss of 2.7%. Over the next month, it was only positive 29% of the time. So again, we provide you with the details here to understand that, hey, when crude oil has rallied this much over a 2-month period, we probably don't want to be long crude oil, and if we're long energy stocks, we better have some tight stops, because energy stocks are obviously highly correlated to crude oil. So this is another tool where we can assess risk relative reward on the website for our users. I think I'm going to take a little break here just for a second. Jay, I just want you to chime in here.
Sure.
And if there's anything that you would like to sort of show, everyone on the webinar today, we can.
Sure. Sure. While I'm doing that, I have a couple things to say, but if you can go back to the main screen and the stock market indicators.
Okay, you want to go to indicators? Okay.
Yes.
Let's see.
And
yeah, let me. Sorry.
No problem. Indicators all the way down to the bottom. ETF seasonality.
Okay, ETF seasonality. Sure.
Since that's where I spend a lot of time. Before I go into that, though, I just want to reiterate a couple things that Dean has pointed out. I mean, one thing we all face is we have to decide how to allocate capital. If we had enough capital to trade everything, we wouldn't need to trade anymore. So it really comes down to, where are you going to put your money that you have the best odds, the best probability of making money. That's why that win rate that Dean showed a few times, to me, that's a very important number. I just like to have that confidence going in, knowing that not every trade is going to work out, but just going in to know that I have an edge. One other thing I want to point out that Dean also mentioned, one way to think about it is, we are analysts, not advisors, Jason and Dean and I, which is actually very liberating for me, because I don't have to make predictions about what's going to happen in the market. All I'm asked to do is objectively analyze things that have happened in the markets in the past, and how that market or that stock or that index or commodity reacted. And that's everything that Dean has just showed you. There's a lot of ways to find an edge in the market that you can exploit. And that's basically everything that we do, and everything that's built into the website is designed to help you with that. Okay, Dean, if you could click on symbol to make that list alphabetic.
Okay.
If you go down to IYT.
All right. Well, let me show everyone. So you can, on our website, we have a lot of search engines. So if we type in IYT, we can quickly access.
So click on that. So I'm probably going to be writing a piece in the next day or two on the transportation index. So IYT tracks the transportation sector. And if you look at this chart, this is annual seasonality. And all it really is just an average of every year how this particular ETF has traded across a year. Most important thing to know is this is not a roadmap. This doesn't never a guarantee of what's going to happen, but it gives us an idea of where we might have an edge. So if we look right about where we are now, we're at about day 192 of the trading year, and you can see from trading day 196 to trading day 137, you kind of see a big upswing. Dean, if you don't mind moving your mouse just to kind of show that from
Yep, right
this
here.
low, a couple days from now, all the way up into December. So if you go ahead and click show growth of $1, and then go ahead at the top and type in the numbers 196 and 237, and then click apply and all at the top of the chart there. Right there. Okay, so what this shows you is the hypothetical growth. If you had started with $1 back when this ETF started trading in 2003, and all you did was every year you bought and held IYT from the end of trading day 196, which is going to be Friday of this year, or Friday of this week, through trading day of the year number 237, which I believe is going to be about December 12th. This would be your equity curve. And so again, like Dean pointed out, what do you notice about this equity curve? Now, I refer to it as LLUR, lower left to upper right. That's really what you're looking for, is that consistent edge. Now, if you look closely, you're also going to find years where it didn't work, where the transports went down instead of up. But once again, the whole idea is to help to find an edge. So right now I'm taking a good close look at the transportation sector. The other thing to note about seasonality, in my mind, it is just one more tool. It's not a magic trick. It's not even a trading system. What I look for is I look at seasonality to find a potential opportunity, and from there I look at price action. And if the security that I'm looking at in terms of seasonality, if it's bullish, if the seasonality is bullish for the next 2 months, and that sector or that ETF is actually trading in an uptrend, that tends to be an extremely powerful combination. It's almost surprising sometimes how strongly some of these things can move if price and seasonality align. And if I can, I'm going to do one more. If you can go back to the menu, I'm actually looking for, go back to that ETF, and I'm looking for USO. And that is an ETF that tracks crude oil futures. And what we're going to find, so here you see it's just about, in terms of seasonality, it's just about to fall off the cliff. What this chart tells you is that late in the year tends to be weak for crude oil. So Dean, if you would, one more time, we'll just do this one quickly. It show growth of $1. It's day 201 through 237, and then apply and click all. And here we see essentially the exact opposite. What's, apparently, I don't know if there's any relationship between transports and crude oil. It sounds like there should be. Looks kind of like an inverse relationship to me. Crude oil goes down, down, down. Apparently that might be good for transport stocks. So for a person who wants to trade crude oil, I mean, there's always somebody out there saying crude oil is going to $150 a barrel or $200 a barrel. Well, that may be true, who knows? But what this is telling us is, on an objective basis, it's not likely to happen in the next couple of months, because as you can see here, it's a very bearish time of year. So one last thought on this is how I would trade this myself is I would probably look at put options on ticker USO. In other words, a lower risk or a lower dollar risk way of trying to play the short side of crude oil rather than selling short shares of USO. So that's just a couple of ideas on seasonality. And once again, I'd be looking, when that trading day 201 comes, and I forget exactly when that is, probably in the next week or two, I'll be taking a close look at USO price action. And if it starts to break down or if it gets below a key moving average, that's when I would look to play the short side. So, Dean, I'm going to throw it back to you.
Okay, thank you, Jay. Okay, so let's just talk a few more things about, the website here. Again, there's a lot of data, there's a lot of indicators, and we know that it can be overwhelming. One of the great things is we do have like a search engine on here. So if you are, again, you're looking for a specific topic like gold, or crude oil, you can quickly search for that. Another example would be our stock bond ratio, which I wrote about recently. So you can come in here and do these searches, click on it, and then you'll drop you over to a chart, where again you can then look at historically what has happened. This is an interesting one. If you recall, early August, the market was in free fall. The media and social media was, all up in arms about the yen carry unwind, and the world was coming to an end. And, I actually came in here and I looked at our stock bond ratio, and I was like, oh, wow, look at this. I mean, this is down at levels that, we saw in March of 20 and, December of 2018, levels in 08, and I'm sitting there thinking to myself, well, things aren't that bad. And again, what we know is a lot of times, people get carried away with the narrative. What we excel at is providing that sort of cool head of, let's take a data-driven analysis. Let's see when this has happened in the past and what potentially could happen in the future. And this was another one where, I published a bullish note. I put a forecast on the S&P, and the S&P ripped to new highs. When everybody else, all the macro gurus were saying the world's over. Again, this doesn't happen all the time, but this is what we provide. There's sort of a term out there in the trading world. It's called situational awareness, and it's a term taken from flying. But this is what we excel at. Is
Right. And Dean, if I could jump back in,
sure.
Everybody has a different approach or different things they're looking at, and these are terrific tools. Like Dean said, you find things that just happen rarely and they're extremely advantageous. There's other things you can kind of follow every day, and Dean showed you one. If you can go back to type in risk on, risk off,
Sure.
just to show that one more time. So this is one thing that you can, so especially if you're more of a longer term investor, you're not really looking to trade in and out. So go ahead and click all. So you just go all the way back on this. It goes back, this one goes back many years. So by looking at this every day, this will give you a sense of whether or not we're in a bull market or a bear market. The other one you can look at every day is the aggregate signal model. If you can bring that one up, Dean.
Yeah, sure.
And I believe I wrote a piece, and I have no idea when it was published. It might have been a while ago, but this is just another, and go ahead, yeah, all again. So this one's really simple. Above the green is good, red is bad. So if you look at these every day or once a week, if both of these indicators are positive, the odds that we're in a bull market are extremely high, right? Nobody knows when the top is going to come, and yes, it will come. But if you're just looking for, like, I always say, don't follow the news, the financial news. That's just me. If you're following the news and you're starting to get concerned and you're worried about reports that you're hearing about this, that, and the other thing, step back, take a look at those two indicators, the risk on, risk off indicator, and the aggregate signal model. If they're both bullish, just turn the TV off or get off the internet and don't worry so much. You always want to have your risk controls in place and stop loss or whatever, but just for getting a real good sense of where we are, those are two really simple but really powerful tools.
And just to elaborate a little bit further, all these indicators, if you subscribe to our Essentials package, which is our website package, you can download these indicators. So if you want to use them as an overlay, say you have, a trading system, and you want to use that as another input, as an overlay of, hey, when it's positive, we want to be in, when it's negative, we want to be, out. You can do that. We also have an APIs. So for, more sophisticated investors, money managers, hedge funds, RIAs, we have an API, so you could download all this and then do whatever you want with it. But I just wanted to point that out that, and again, just as I mentioned earlier, again, we have these overlays. So as Jay was saying, you can sit here and look and, well, what has this indicator done, when we're in a bear market? Or, if we want to see recessions, well, how does it align with recessions? And again, you can generally see it's down here in the negative territory during recessions. So excellent, sort of tools. While we're at it, and again, what you can do is you can add this to your favorites. So you just click favorites, and now when you go to your favorites on the website, you'll have a whole list of all these favorites that you can see here, where, each night you could come in and you could look at your favorites. And just a word about this sentiment column here at the end. Green is sentiment, pessimistic. Therefore you want to be long. Red, it's too much optimism. You want to be careful. We're actually in the process of changing this so that we're actually going to give you a threshold level returns, so that if the indicator is above this level, the S&P 500 will annualize at this return. If it's below that level, it'll annualize. So you'll have some more, context in terms of what these indicators are saying, what it means for the market. Again, with this, then under my services, or excuse me, under my account, you can come in here. We have website preferences. So each night, if you just click on evening digest of your favorites, you'll get the evening digest. It'll have all your favorites in there, so you can quickly see in an email, what might be showing extreme optimism or pessimism. And you can obviously subscribe to these other sort of services. One of those services here is our strategy alerts, which we haven't talked about. So I think that'd be a good time to kind of shoot over there and look at our strategies, because I mentioned earlier. So if we go to strategies, what we see here is again, these are predominantly price momentum, relative strength. Some of them have fundamentals, some of them use sentiment, but for the most part, it's price and relative strength. We break them out in terms of sort of these categories. So you can see like index-based strategies. You can also see sectors. So let's just kind of take a look at sectors. And again, what we can see in here is this will give us a general sense of what sectors are leading the market, right? That means what sectors are outperforming the broad market. In this case, it's the S&P 500. And what we can see here is on buy signals right now, we have consumer discretionary, healthcare, utilities, real estate, staples, and industrials and financials. So, we've got a good amount of sectors that are on buy signals. When a sector is not on a buy signal, then we just allocate to the S&P 500, which you can see down here, which tech, communications, and growth. Just a few weeks ago, this was predominantly defensive sectors, right? Because we've been in this sort of consolidation pattern. We've got the Fed meeting, we got the election, and so we've had this sort of hesitation. And what we saw via relative strength was that the defensive groups were sort of leading the market. But now that is starting to, we're starting to pick up other more cyclical areas like industrials and consumer discretionary, which are now on buy signals. And again, you can see in here, if you click on these, we've got an explanation. You can see what the strategy's compounded at, whether it's outperformed, the broad market. We have tables and charts and annual returns. And so you can get a general sense. Again, while this is meant to be actionable, it's also just to give you another sort of resource in terms of what's leading and lagging the market, so that you have an understanding of like, okay, are we, in a growth phase? Are we in a value phase? Okay, what sectors are leading? Is it tech? Is it consumer discretionary? And it acts as just sort of a check and balance. Again, if you like XYZ sector, but you come in here and you see, well, XYZ sector is not on a buy signal, that means it's not leading the market. Then that just gives you a sort of check and balance of like, okay, well, wait a minute, why is this not outperforming the market? Everything else is aligned, and it's not outperforming the market. So that means we need to do further due diligence. Another category is bonds. And again, what we do is we compare bonds to cash. And in this case, it's the 1 to 3 month T-bill to cash proxy. And what we can see in here is that every single bond category, whether it's the 1 to 3 year treasury or investment grade bonds or high yield bonds, municipal bonds, they're all on a buy signal relative to cash, right? And what we know is we've seen this big rally in bonds as the Fed had, decided to shift their policy stance. And this went long all these bond categories and is avoiding cash. Conversely, in 2022, what we saw in here was that every single bond category was on a sell signal, meaning these relative strength models favored cash. And what we know is bonds had one of the absolute worst years in history in 2022 and into 23. So again, just providing you with this sort of context, this check and balance of what is the market saying, and does that align with my thought process, or does it not align with my process? Jay, you want to add something?
Yeah, another what I call a quick and dirty way. If you go back to the main menu and go to just to get a quick glimpse of where sentiment is, go to Tools.
Okay,
And then
tools.
the Optix heat map down a ways. It's up a little bit. There you go. So this Optix is our own. Well, Jason developed it many years ago, measuring sentiment on a given security. And what you see, the ones in red, if you go ahead and just click on like SMH, which is a semiconductor. And so what you can see, this can move up and down quite a bit, but this is telling you that traders of SMH are fairly bullish at the moment. Now, if you can actually go back, I think you can either go right back to it. Yeah. So what you're going to find, so the ones in red means that overall there's a lot of bullishness, which from a sentiment basis tends to be negative. It means we want to be a little careful about chasing that. And then on the lower right in green, you see the ones that are getting down low, meaning investors or traders are bearish. And so the time to really look at this is when there's a big move in the market, because what you're going to find at times is you get a big sell-off that lasts a couple of days or a week, and you come in here and you see an ocean of green. And so I talked before about being 100% objective. What I'm telling you right now, I'm going to be honest, is really 100% subjective. But again, it gives you, it's a quick way to get a sense of whether things are getting overdone. When you come in here and the vast majority of these are lit up in green, that tells you the sell-off is probably getting overdone. It's time to start looking for a time to buy. It's not an automatic buy signal because everybody will see a different thing. And then on the flip side, you come in here in the midst of a big rally and you see almost nothing but red. That's telling you that if you're a trader, maybe it's time to pull back a little bit, time to start thinking about how you're going to lock in profits. So that was just one more entirely off the beaten path subjective thing that I tend to look at.
Correct. And you can apply, and like Jay said, this, these Optix indexes, they move around quite a bit. So you can apply moving averages to it to sort of smooth it out. And of course, up here, this bar up here, if you wanted to do, a 10-day average, then it would show you the 10-day average Optix level. So a lot of different ways to sort of slice and dice and the data. But yeah, this is another excellent resource on the website to get a general sense of optimism or pessimism in the marketplace. We've got about 10 minutes to go here. So I think what I'm going to do is let's go back. I know we've covered a lot of things. Let's take a look at some of the questions, and then we'll talk about our packages. So, again, how do I begin in trading or investing? Well, probably, my recommendation, and I know Jay will want to chime in, is really is get some books and start reading. All of the Market Wizard books are excellent to give you a sort of general sense of what it takes to be successful in trading. If there's if you're in a city where there's a CMT association and they hold meetings, I would highly suggest attending the CMT association, which is the Chartered Market Technician Association. Attend those meetings, and then, just find people. I would suggest get on X or Twitter. There's you have to be careful about who you follow, but there's a lot of really good free resources that you can find on Twitter or X or even on YouTube. Really excellent videos. So that's how I would start in terms of trading, investing. And I would paper trade, for 3 to 6 months. But what you really need to do is you need to decide, do I want to be a short-term trader, a medium-term trader, or do I want to be like sort of a long-term investor? That's the first thing you need to decide. And then from there, it just requires a lot of study and practice. You probably will not be successful for a few years, but those were just some sort of recommendations. Jay, anything from you?
Yeah. So, like I said, everybody has a different way of looking at it. I actually have a trading account and an investing account. And so, just to separate those two, even though you do the same thing, you place buy and sell signals. To me, trading is trying to find a way to make money right now, whether it's long or short. Investing is more putting money to work in order to make money over a longer period of time. So that's really the first question you have to ask yourself, because a lot of people get into trading. I'm just going to trade short term, and then they buy something and it goes down, and they go, "Well, I guess I'm a long-term investor now," and that's a good way to get in trouble. As far as trading, especially short-term trading, my suggestion is, obviously you have to do some homework, you have to do some study to find out whether you're going to be a trend follower or reversal, swing trading, whatever it is. Anything can work as long as it works for you. I would paper trade for no more than a month or two, and then I would start with the smallest position size you can possibly manage. And for the first 3 to 6 months of trading, how much money you make or lose is, as long as you're trading small, it's almost irrelevant. What's important is getting the feel for what it's like day to day. Because one thing I would tell you, there is a feeling you get in the pit of your stomach when you lose more money than you're comfortable with that cannot be explained. It cannot be learned by paper trading. It can only be learned from trading. So getting the basics down of how to get in and out, when to get in and out, is really the first step. But it's best if you're doing it with real money, but not much.
So, what is the best way to improve my trading skills? Well, I think we kind of covered that with the
That's
first.
essentially the same question.
Yeah, it is. Your analysis process, research methodology. I think we somewhat covered that. Again, we're a signal-driven, evidence-based research provider, daily notes, weekly summary, and then tools on the website to help us understand what is going on in the market. We in a bullish environment, a bearish environment, and that's what we do. We take that sort of top-down, big picture macro view, Once we have the understanding of where we are in terms of the market, then from there we can build from the bottom up and use relative strength to identify which sectors are the most favorable and go from there. So that's generally, we're all sort of on that same page. I mean, Jay and I may be a little more trend following. Jason may be a little bit more of a counter trend type of trader. But again, that just gets back to what Jay was saying earlier. Everyone has sort of their different approach, analysis, methodology, based upon their risk tolerance, really.
Yeah. So one piece of advice I give to somebody who's just starting out is, just for your own knowledge, my opinion is more money is made trend following than any other way. It's like riding the wave. So take a close look at that. One thing I want to mention, though, I have read 1,000 books on investing and trading, and you hear different things. Whenever you hear someone or read someone say, in order to be successful as a trader, you must, what it really should say, what should have said is, in order for me to be successful, I must. What you have to do may be something a little bit different. So there's a little bit of taking in as much information as you can, and then pushing back out about 90% of it, and just leaving the parts that make sense to you, that are comfortable to you, and then making sure that you have some risk control built in. So in the real world, you don't get clobbered.
Correct. No matter what type of trader investor you are, you need to have a plan. And then
Yes.
the key is you need to have the discipline to carry out that plan. The reason why people fail at trading is because discipline goes out the door. But again, have a plan, have the discipline to carry out that plan based upon your own risk tolerance.
Right. If I can jump in there, one thing I've told people a lot of times is, the day comes when you get into a trade and you get stopped out with a reasonable loss that you said, I can take this size of a loss, and you feel no emotion whatsoever. That's the day you can start to be a wildly successful trader, because you have a plan, you stuck to it, and even though you lost money, which we all hate, it didn't affect your thinking on the next trade going forward. And that's really what you want to strive for. And even when you get to that point, to keep doing it, trade in and trade out.
Yeah. Okay. What kind of tools do you provide that are suitable for new traders? I'm not necessarily sure we have something for new. I mean, what we try
Right.
to do is provide tools that are just easy to use, like what we, had showed earlier with our backtest engine or our correlation pattern match tool. You don't need to have any programming skills. It's point and click. Condition one is this, condition two is that. So again, we're trying to provide simple, easy to use tools that a hedge fund manager could use, or just even a novice trader could use. But we're not necessarily just saying, hey, we're creating this just for new traders. And how can I access your resources for trading? Well, again, we've got several different sort of packages. So why don't we shoot over there, and let's take a look at what we have to offer. One of the sort of complaints that we get, from people that subscribe to our service, and especially the essentials package, which is, our website package, is that, there's just too much information. It's there's so much information and I just don't have time to use it all. And so, again, what I would suggest, anybody that's listening today that's considering, using us as a research provider is I would suggest this: subscribe to our research reports. And that way you get sort of a general understanding of what Jay, Jason, and myself are thinking. Within those research reports, we're going to use a lot of the tools that are on the website. And so that'll give you sort of an idea. And there's plenty of notes where we'll walk you through, okay, here, I created this signal in the backtest engine. Here's how I did it. and you can follow along. We also have the ability to where we can share those those back tests with subscribers. So again, my thought is start with the research reports. If you're just sort of a new novice trader, you're thinking about our service. And then after a couple months, when you get comfortable and you see what we're doing and how we're using the website, then upgrade to the Essentials package. And then you can go in there and start to use those tools that we're using on a daily basis. Jay, do you want to add anything on that front?
If you really, what Dean said makes perfect sense. If you're just getting started and you want to get an idea of what we're looking at and different ways to look at the markets, the reports will give you tremendous guidance, I promise you. Because again, we're not here going, I think I'm going to make a prediction about crude oil or something. All we're doing is looking at objective data and saying, here's what's happened in the past. Here's what it probably mean or could mean going forward, and just helps you zero in on opportunities. But if you're a hands-on trader or investor, by getting the Essentials package, you'll have access to a lot more tools.
Right. And then, like I said, once you get comfortable, then you can move up. And again, it all just kind of comes down to how much time you have. Are you just a casual investor? Are you a serious trader? It all depends on that, really. Listen, we think there's tremendous value in what you get in terms of these packages. If you go look at some of the other research firms, the boutique research firms on Wall Street, our pricing is outstanding, relative to these other firms for what you get and the insights, the data, that, like I said, you're not going to find anywhere else in the world.
Yeah, one thing I always tell people, when I started in this business roughly 1,000 years ago, it probably took me 10 years to get access to the kind of data that's on our site that you can get immediately. And that takes you a long way. There's a learning curve in trading, and the more access you have to useful data and ways to actually objectively analyze it, it really cuts down on the learning curve.
Yeah. And one of the things that we haven't really touched on today is we have an excellent programming team. And so if Jay or Jason or myself want to create a new indicator, or we want to put something new on the website, or if a client sees, for instance, Jay had an inflation model that he published, in a note, and a client was like, wow, I'd really like to have that, or put it on the website. Those are things that we can do, that we can turn around. Obviously, if it's within reason. But like I said, we have just a really awesome programming team, and so we have tremendous firepower at our disposal. So that is another added benefit that you kind of don't get, or you don't see here, in terms of if you're paying $590 a year, we've got that as well. So just wanted to add that. Just I'll say a few brief things, and then Jay, maybe a brief few things on the market, and then I think we probably need to wrap it up here. We're a little over time, but I remain constructive on the stock market. The primary trend is up, and what I'm seeing in terms of breadth and other data is confirming that. I really don't see anything that says I should be questioning the uptrend at this point. I think, again, as is typical, October's seasonality can be a little iffy. We've got an election next month. Typically, ahead of elections, the market consolidates. It's really just more of a buyer strike than anything. But what I'm seeing continues to look constructive, and we should have the typical year-end rally once the election is out of the way. Jay?
Yeah, very simply, the things that I follow are still bullish on stocks, so I'm still bullish on stocks. It's as simple as that. If that changes, if the indicators start pointing more negative, then I'll take a more negative stance. I'm still not terribly bullish on bonds, just because, again, some of the things that I've written about and follow, they've picked up. But in terms of where to allocate capital, I'm still focusing on the stock market over the bond market and also over commodities. I do follow commodities, and they're picking up also, just like the bonds, but they're not quite there yet. So that's where I'm at.
Okay, well, we want to thank everyone for attending today's webinar. And if you have any questions, either just general in terms of our services, or if you want to ask Jay or myself something about one of the comments we made today, just shoot an email to admin@SentimentTrader.com, and we'd be happy to get an answer back to you. And once again, thank you, and we hope you join our research team.
Thank you for joining us today.